But before we start to discuss our main objective for today's presentation, have you ever wondered how companies large as San Miguel Corporations manages its cash across operations, investments, and financing? Today, we will uncover how money moves through one of the Philippines' largest conglomerates. In this presentation, we'll take a closer look at San Miguel Corporation's cash flow statement for 2023. Our goal is to understand where the company's cash comes from, where it is being used, and what this means for its financial health. First, we're going to take a look back operating activities. It explains how the business generates cash from operations. In 2023, the company generated 5,292 million pesos from operations, compared to 22,624 million pesos in 2022. Below is a breakdown of what affected the company's operations cash flows. Second, the San Miguel Corporation's investing activities in 2023 reflect its commitment to long-term growth through investment in subsidiaries, property, and financial securities. However, the company incurred significant cash outflows, resulting in a net cash outflow of 127,301 million pesos. This is slightly lower than the 141,925 million pesos net outflow in 2023, but still places substantial pressure on the company's cash reserves.
Third and the last, San Miguel Corporation's financing activities reflect how the company manages its debt, equity, and dividends to maintain liquidity and fund operations. In 2023, the company recorded net cash inflows of 41,456 million from financing activities, driven primarily by borrowings. However, the high levels of debt repayments and dividend payments highlight both opportunities and risks in the company's financial strategy. Ratio analysis. In year 2023, first, to compute current liability coverage ratio, we need to compute first it by operating cash flow divided by current liabilities, which are 5,292 million divided by 172,625 billion equals 0.031 or 3.1%. Second is operating cash flow. To compute this, we need to compute it by operating cash flow divided by total liabilities, which are 5,292 million divided by 628,312 million equals 0.0084 or 0.84%. Third, price to cash flow ratio, which is none. Then the fourth one is asset efficiency ratio. We need to compute it by operating cash flow divided by total assets, which are 5,292 million divided by 1,180,893 million equals 0.0044 or 0.44%. And the last one is external financing ratio. To compute this, we need to compute the cash from financing divided by cash from operations, which are 41,456 million divided by 5,292 million equals 7. Findings. First, operating activities. Net cash flows from operating activities, which are in 2023 5,292 million, and in 2022 22,624 million. We can see that there is a significant decline in net cash generated from operating activities in 2023 compared to 2022. This may be driven by a higher losses before tax, which are 14,369 million in 2023 versus 7,794 million in 2022. and greater outflows from working capital changes. Then the second one is investing activities. Net cash flows from investing activities in 2023, 127,301 million, and in 2022, 141,925 million. Despite slightly lower outflows in 2023, the company continued significant investments. Investments and advances were the largest outflows, totaling 189,611 million in 2023 and 164,039 million in 2022. Then the positive cash inflows, collection of shareholders' advances to subsidiaries in 2023 amounted to 35,227 million compared to an outflow of 32,988 million in 2022.
And 582 pesos million, and 2022 137,258 pesos million. Conclusion. Number 1, declining operating cash flow poses a concern. The significant drop in cash flow from operation from 22,624 pesos million in 2022 to 5,292 pesos million in 2023 indicates operational challenges. Number 2, high investment outflows remain a strain on cash reserves. San Miguel continues to allocate substantial cash toward investment, with outflows totaling 127,301 pesos million in 2023. Number 3, increase our reliance on borrowing to sustain liquidity, despite to generating 41,456 pesos million from financing activities. The heavy reliance of debt increased financing risk. Number 4, deterioration in liquidity position. The company's cash and cash equivalents declined from 137,258 pesos million in 2022 to 56,582 pesos million in 2023. Dividend payments may be used unsustainable given cash constraints, continuing to pay dividends totaling 9,314 pesos million despite weaker operating cash flow suggests a potential misalignment between shareholders' payouts and financial sustainability.
Recommendation: improve operating cash flow. The company should focus on cost reduction initiatives, especially around operations, to improve margins and reduce losses before tax. Number 2, optimize investment spending. The company should reassess ongoing investments to prioritize high return projects and delay or divest from non-core assets. Number 3, refinance debt and manage leverage. The company should refinance high cost debt and extend maturities to ease cash outflows. Number 4, control dividends payouts. The company should consider reducing dividends temporarily or adopting a payout policy tied to free cash flow to conserve cash. Number 5, strengthen liquidity management. The company should build cash reserves through internal savings and selective financing.